What's up, guys? Welcome to my YouTube channel. If you are into simple, no hype stock analysis, you are in the right place. Today we are going to break down Arista Networks, ticker symbol ANET, and see whether it's actually worth buying at current prices. First thing, let's discuss what the company does. Arista Networks is basically a company that builds high-speed networking equipments used in data centers. Arista's biggest customers include major cloud providers like Microsoft and Meta. And with the rise of AI and cloud computing, the demand for fast data movement is increasing, which puts companies like Arista in a strong position. Let's jump into the revenue growth section. Arista Networks' current share price stands at $131 and with a market cap of $178 billion. In terms of revenue growth, as you can see my table here, revenue increased from around 2.3 billion in 2020 to about 9 billion by 2025, which is a massive jump in just a few years. If you break it down a bit, growth was around 48% in 2022, then 33% in 2023, and even in recent years, it's still growing close to 20 and 30 annually. So yes, growth has slightly slowed compared to earlier years, but that's completely normal as the company gets bigger. What's important here is that growth is still strong, and it's mainly driven by increasing demand from cloud providers and AI infrastructure. So overall, this tells me that Arista is not just stable, it's still in a strong expansion phase. If we quickly move into profitability section, I have listed the EPS margins and net margins here in two separate tables. And if we start with earnings per share or EPS, the company has grown from 0.50 in 2020 to 2.75 in 2025. That's a very strong increase over a relatively short period of time. What I like here is that the growth has been consistent. EPS grew more than 60 in 2022, over 50% in 2023, around 35% in 2024, and even 2025 it was still up by more than 23%. So even though the growth rate is gradually slowing, which is normal as a company gets larger, and the overall earnings trend is still clearly moving in the right direction. Now if we look at net profit margins, Arista is doing even better than I expected. The net margin improved from about 27.4 in 2020 to nearly 39% in 2025, and it even crossed 40% in 2024. That's a huge positive because it shows companies not just growing sales, it's keeping a very large portion of that revenue as actual profit. And to me, that says few things. First, the business is highly efficient. Second, it likely has strong pricing power. And third, management seems to be executing really well. Even though net margin came down slightly from 40.7% in 2024 to about 39% in 2025, I wouldn't see that as a major concern. A margin at this level is still exceptionally strong. So overall, Arista doesn't just look like a growth company, it looks like a growth company with very high quality earnings. And that's exactly the kind of thing long-term investors usually want to see. Let's move into the section 4, free cash flow. As you see in my table, if we go back a few years, Arista generated around 950 million in 2021. But then we see a sharp drop in 2022 to about 450 million. Now at first, that might look concerning. But what's really interesting is what happened after that. In 2023, free cash flow jumped significantly to around 2 billion, which is a massive recovery. And then 2024, it increased further to about 3.7 billion. And in 2025, it reached approximately 4.25 billion, still growing at around 15%. So what this tells me is that the dip in 2022 was likely temporary. And the company has since entered a very strong cash generating phase. And this is important because strong free cash flow means the company has real financial strength. It can reinvest into the business, handle downturns, and continue expanding without relying too much on external funding. So overall, Arista's cash flow profile looks very strong, especially in recent years. Now let's talk about valuation. And I'm going to be very direct here. Arista is currently trading at a PE ratio of around 47.5, which is quite high. To put that into perspective, companies like Cisco are trading at around 28, and even Nvidia, a major AI growth company, is around 35. Only Broadcom is higher at around 60. So compared to its peers, Arista is clearly on the expensive side. Now, if we go one step deeper and adjust for growth using the PEG ratio, Arista comes in at around 2, which again suggests that the stock is priced above its growth rate. And looking at price to sales, the number is close to 20, which is also very high, meaning investors are paying a large premium even for revenue. So across multiple valuation metrics, PE, PEG and PS, the conclusion is consistent. This is a high quality company, but it is also a highly priced stock. Before getting into numbers, the idea here is simple. We are trying to figure out what would be the reasonable price to pay for this level of growth and profitability. The company is currently generating about $2.76 in earnings per share. And based on its growth of around 25%, I'm assuming a reasonable PE range of about 30 to 40. This range comes from a standard rule where a fair PE is typically around 1 to 1.5 times the growth rate. And I'm also cross-checking that with peers in the same industry. So using that range, we can estimate fair value. At the low end, 2.76 multiplied by 30 gives around $83. And at the high end, 2.76 multiplied by 40 gives around $110. So overall, the fair value range comes out roughly between 83 and 110. Now, when we compare that to the current price of around 130, the stock is clearly trading above this range. Now let's talk about some key risks beyond the numbers. One major factor is customer concentration. Arista relies heavily on a small number of large cloud customers. So any reduction in their spending could directly impact revenue. Another important risk is its dependence on cloud and AI infrastructure demand. The company is benefiting from these trends right now. But if spending in this area slows down, growth could be affected. There's also strong competition in this space from companies like Cisco and other networking players, which could create pricing pressure or impact market share. In addition, technology in this industry evolves very quickly. If the company fails to keep up with innovation, it could lose its competitive edge over time. And finally, since many of its customers are large enterprises, they have significant bargaining power, which can influence pricing and margins. So while the business is strong, there are some important risks to keep in mind. So overall, while Arista is a high quality company with strong fundamentals, the current valuation looks stretched. For me, this is a hold or wait for a dip, not a buy at current levels. That's the breakdown. No hype, just the numbers and the logic. Stay tuned, we'll be analyzing another stock in the next video. Until then, cheers. Bye.